Welcome, everybody, to the Financial Advisors Workshop. This is where we interview some of the top financial advisors in America. Today, we have Joshua Cavett, and he's in Beaumont, Texas, and he's quite an interesting character. Welcome, Joshua, to the Financial Advisor Workshop.
Thank you, Brian. I'm excited to be here.
Great. And Joshua runs Beaumont Wealth Advisors, but does a whole lot of other things. And we're going to learn about some of those things as well. He's a serial entrepreneur with lots of great ideas, lots of energy, two mouses, and at one time, really incredible story. So, Joshua, tell us a little bit about how you got in our business first.
Sure.
Wealth.
So after graduating at Texas A&M, I initially wanted to go into public accounting, got my CPA license, then did some accounting work there at my father's firm, who has about 60 accountants. And then moved over to Spain, went to university there. My wife and I started dating there. And then after moving back, I started kind of pursuing doing the investment advisory side. And kind of doing those two together was a good experience. And it allowed me to realize that accounting is a service that nobody wants, but everybody has to have. And I quickly realized that I love sitting down with people and giving them the service that I can give them a lot of benefit rather than just producing a tax form. So then kind of fast forward a few years, I was like, I've got to stop doing, the accounting side. It became too much, still keep up my CPA license, and then went into the advisory practice full time. And it's been fantastic. I would say at that time, we had around $100 million in assets, and we've grown now to a little over $1 billion with the three advisors that we have, Angie White and LRNR that I work with them. We were with Raymond James our firm was with Raymond James for 20 years. And then last year we made the hard transition of going into the RIA space. We use New Edge Wealth or New Edge Advisors. And we're trying to drop our licenses with FINRA over time to be 100% fee-based. And they've been fantastic. They've kind of helped us be in our compliance and our marketing of our firm. But they allow us to be able to utilize, our name, Wealth Advisors.
Nice.
And additionally, we also have LPL and Fidelity and Charles Schwab and Raymond James RCS as custodians there to be able to help our clients.
Why do you have so many custodians, Josh?
Those are the companies that they have, and because they have lots of advisors on each of those platforms. They're looking at adding Goldman Sachs, but it's not out yet. And so, but it gives us a large array of tools to be able to utilize. I think it's helpful.
That's right.
Any rather than just one, because if we wanted to move business to Fidelity or to a different company because of whatever reason, we really like the flexibility to be able to do that.
Nice. So now, what is your business comprised of? I know you do some work in structured notes, but is it all structured notes or is it other things?
It's not all structured notes. We run our own model portfolios, and previously we were non-discretionary. We were meeting with the clients and saying, "Is this okay to do that or not?" I think that it's not a good position to be in, because the client is either going to be very happy with you or unhappy with you, and they're kind of directing those decisions. I started moving more towards model portfolios that really developed. So we do run some model portfolios. I absolutely love structured notes just because of the downside protection, and it really resonates with clients right now. Whenever we're meeting with them, and they I can talk on that for a long time. Happy to go into a deeper dive, but the structured notes, and we stick very simply to callable income notes and growth notes, auto-callable growth notes. And it doesn't need to get too fancy. And we just continue to repeat that story with our clients and showing them the results of that, and they really like it.
Nice. So how do you use structured notes? You were talking a little bit earlier about how you do some maneuvering with them, and you get customized structured notes. And
so on the income side, we're primarily utilizing those inside of qualified accounts because of the taxation. We'll do usually it'll always be a 3-year and it'll be, but sometimes we'll stagger those out to where it's paying monthly based upon certain indexes. If I've got a client, they come to me and we're building out $1.2 million portfolio, what I don't do is say, let's put all this in structure notes. Is I say, let's break that down into the next year, and let's do a ladder portfolio of structure notes. Let's break each of those $100,000 in each of those months down into maybe 4 or 5 different notes. So after a period of time, we have 60 notes inside of there. And if one of them ends up not doing well, we have 59 others that are. So that's a very diversified way across issuers, across indexes, across time, and it provides a fantastic ladder portfolio for a client. On the auto-callable growth notes, we'll usually use a 90% or 85% auto call feature, to where after 1 year or 2 years, et cetera, whenever it reaches that milestone, then it goes back to cash, and then we just rinse and repeat and do the same thing. And for Raymond James, primarily where my assets are right now, they will go and do all the legwork, compete it out across the issuers, go back and usually get better terms, and it works really well.
Nice. How did you get into structured notes? What attracted you to them?
I got into them about 5 years ago, and what really attracted me to those is the downside protection that they have. It's almost like an insurance policy, and what I love about it is that I like my yes to be yes. Whenever I tell my clients, this is what's going to happen, I don't like to have some uncontrolled inside of there. And so whenever I learned this lesson 2 times, kind of with bonds, with kind of getting burnt on bonds, with one with Meredith Whitney time. And I think there's a lot of risks that people just don't realize that are actually inside of fixed income.
Yeah.
And secondly is I was using a short duration fund, and I was like, this is going to be real boring. It's going to get 3%. And all of a sudden it's showing that's like 93 cents on the dollar. And these clients are like, what is going on? And so I like, whenever I say this is what's going to happen, for it to actually happen, and to be able to look my client in the eye and say, if it's within these parameters, we know that your portfolio is going to do this, and if it goes below, well, that's why we diversify it out. And so I did them in my personal account, and just over time said, man, I felt really comfortable with these, and then started implementing that to clients. I didn't want to just go into it blindly and start doing it, but the more I do it, the more I love it. And yeah,
that's great. Mm-hmm. And you ladder it like a ladder of different maturities, different income payments, and things like
different indexes, different time, etc. It's very diversified.
Very interesting.
Yeah, it's like having an insurance policy, to protect the client's downside. If you're invested in a traditional, I think what has always worked in the past for us as advisors and doing a blended portfolio may not work going forward as well as it has. I'd say if you just get good single, returns in a kind of 9 to 12% range, you're providing your clients so much of a benefit on compounding, rather than, they're going to be happy with you if the market's up, and they're going to be very unhappy with you if the market's down.
Mm-hmm. The structured notes, you don't need to worry about that.
No, but I do warn the clients that there's a statement risk, right? So if we buy something, it may show lower for a period of time on your statement, but I talk them through it. I said, this is what's going to happen. So that way, if it is down and it's down 5% or 10% of an index is down, they know that, and they know that they're going to, as long as it doesn't breach that barrier, they're going to get that amount at the end of that term.
Yeah, no, that term. Good. Have you have any that go south on you? Any defaults?
Sure. Great question. And whenever oil and gas was down in 2000, it was down a lot. We had, some clients that had those inside their portfolio, and it would be 100 cents on the dollar, and all of a sudden it shows 20 cents on the dollar. Some clients did a fantastic, as I sat down, I was like, this is uncomfortable, but how do we use this to our advantage? And so we transferred some accounts from a traditional IRA to a Roth IRA, paid taxes on it at a much lower price, and lo and behold, came back and as those mature, those particular ones, it did an amazing return and goes back to cash. And it was like, this is phenomenal. We paid taxes at such a low price, and now it's maturing and it's doing it. So out of thousands of them that we have done, we did have one that matured and it was down 31% and it had a 30% barrier. So those clients did have, that one note that didn't do well, but we've never had another one that has matured below that, which is amazing.
That's great.
Yeah.
So this is an interesting feature of your business, but not even as interesting as all the other things that you do in your life that kind of lead into this. So give us a little sense of the entrepreneur that is Joshua.
Sure. So I was at a conference with New Edge. I was talking with Neil Turner at New Edge, and I kind of told him, "Hey, here's what I'm doing." And he said to me, he said, "You're not an advisor. You're an entrepreneur, and an entrepreneur that happens to advise clients." I didn't like it. I thought about it for a few days and finally came back. I said, I think you're right. I have a passion for starting businesses. And so, we helped start a school, start a church. There's lots of different companies. I am terrible at maintaining businesses. And so I figured that out pretty quickly that I like to start these things, and I love to be able to have somebody maintaining them. That's a fantastic scenario for me. And so that's kind of the same thing in my business. Is I love picking up assets and meeting with clients. I am not as good at maintaining, and so I had to create lots of efficiencies of scale in the practice to be able to do that. So I'm all over the place, but I am also creating inside of our advisory business, ways to be able to have junior advisors take on lower level clients, doing some more segmentation inside of there. I am always looking for the most efficient way to be able to create efficiencies in practice. So we'll get down in technology and hardware and software and different things, but I think there's so many ways to be able to grow the practice. That's kind of what I enjoy doing. Does that answer your question?
It does, absolutely. Well, and you also run your own model portfolios too, right? You had mentioned that.
Yeah, we do. We have Beaumont Wealth Advisor models to where we go in increments of 10 from a fixed income portfolio all the way up to 100% growth. Then we also add in a buffered ETF sleeve into there for clients that want that. We primarily utilize First Trust, fantastic company, and they have different buffers on there, and it works out well.
Very good. Well, so what kind of trends do you see in the financial advisory business now? You've done it all, and you're big in structured notes, and you've got a almost $1 billion practice at this point, right?
We do. Trends in the financial industry. I think we are some of the first advisors that are having to deal with inflation in 40 years. It's difficult, and I think we're going to see. I think we're going to see a lot more inflation. I don't think that it's ever going. I mean, it may get slower, but it's never going back to where it was. And we're going, as the United States continues to print money, we're going to continue. The dollar, it's still in your pocket, but it is not going to go as far as people think it is. So we're going to have to work harder to keep our clients up with inflation than we have had in the past. That's lots of it's a very open-ended question on trends. I think additionally, like with AI coming out, I think it is very important for advisors to embrace technology rather than be afraid of it. Lots of different ways to be able to improve in that area, in my opinion. And I kind of equate it to, let's say, virtual reality versus augmented reality. Virtual reality is really cool. And if you've ever worn a pair of the glasses, it's neat, but it's not very good because it distorts your reality, because what you think is right there in front of you or far away is really close to you. I think, whereas an augmented reality has a perception of you can actually see, but then you can add those things in. So inside of our practice, I think we're going to need to implement certain types of technology to continue to grow rather than just doing what we traditionally do. So it's kind of uncomfortable, but does that answer your question?
It does, absolutely. Good. And you mentioned all these other adventures that you've been involved in, starting other companies. How does that help in the financial advisory business? Gives you a perspective, doesn't it?
Gives me a great perspective because it gives me a lot of experience. I'm a very introverted person. I don't like being in front of people, but I force myself to do it in doing conferences and doing this. And so I want to force myself into doing other things that are, other businesses to kind of give me experience to be able to deliver that same experience to clients and have wisdom in advising them rather than just focusing on what my practices over here.
Nice. Now you travel a lot as well. Tell us about that.
My wife and I absolutely love traveling. We travel with our kids, or we'll do it just adults. Done multiple trips. My wife and son actually did 7 half marathons in 7 days on 7 continents in January and February. So it's pretty intense. Wow. I would love to, implement more travel with clients and with prospects. We're planning a trip to Japan next year that the clients pay for themselves, but everything is done, and it allows us to be able to create more meaningful relationships with those clients and be able to invite top prospects on there. And there's one that we're inviting is probably closer to $1 billion, which is fantastic. I want to be talking with those people, hanging out with them to be able to create opportunities to pick up additional assets in the future.
Mm-hmm. Excellent. And your accounting background helps you in many ways, I suspect.
Absolutely.
Yeah. Good. Now you also have been a professor.
I was a adjunct professor at Memorial University for a period of time, which that was a good experience as well. And it was difficult at times, and I didn't enjoy it, but I did it, and it's that day's past me now, and I'm enjoying doing what I do rather than being a teacher.
So, Josh, the $1 billion in asset, that's really your practice.
Mm-hmm. Angie, Ellen, and I, the 3 advisors. Now, I will say we did not create this practice. Ron Lanyon, who works with us, he came to my father and Angie's father in 1999 and said, we'd like to open up an investment advisory practice. He was at Edward Jones previously. And what he did was he said, the income that I'm making, I want to continue making that income, but whatever additional amount that comes in, we're just going to split it a third. And that allowed the branch to just continue to grow because the accounting side is now referring it to the investment side. Then Larry Turner also, he has another company, which is a third-party administration firm, TPA firm, and we can send our 401ks there to be able to have the plan administration done. And so it kind of worked together to be able to have a referral service and just continue to grow over time. So we didn't create it. I came on in 2006 and Angie a little bit later, but we've kind of worked on it, grown it, and just continued to provide a good level of service to our clients. That's really what we focus on. And it's grown pretty larger than I think we ever thought it would grow. And we hope to, be $2 billion at some point in time, and hopefully in the near future. We also have professional partners, and the professional partners at other accounting firms, whenever they refer us clients, we're able to disclose that to clients and be able to pay them a percentage of those assets. And so that has also helped us with growing assets.
Oh, I bet it has. Well, good. So what do you consider to be the main reason for your success in developing all this? What do you think is the secret sauce for Beaumont?
Yeah. The secret sauce is sitting down with clients, meeting with them, and doing a great goal plan with them. That's that. Whatever I sit down with the client and we go through, we do all this inputting, all their information. I get to the very end and we say, you don't need stocks, you don't need bonds, mutual funds, or structured notes. You just need to reach your goals. And that's what you need. And I then usually pair that with an example of, here's a recent client that came in and he sells bricks. And I asked that client, how many of your clients need bricks? He's like, well, all of them. I'm like, no, they just need a house. You are solely selling them the tool to be able to achieve that. And so I'm doing the same thing here. I am giving you the tool to be able to achieve what you need. So that's really, whenever we say that, it's usually just like a 90+% close rate whenever we're meeting with clients or prospects.
Right. So good planning oriented program that gives them some direction, isn't it?
Sure. Yeah. So this came about with, I drove to Austin to meet with a prospect, and I met with them, and I thought did a fantastic job. And then they called, let me know, hey, we're going to go with this other advisor. I was like, well, that's great. Can you tell me why? And so she said, well, they were better at articulating the services that they provide. And I was like, well, I have all the same services. And she was like, yeah, but you didn't do that. So I took that lesson. I said, how do I make something really good of this to be able to gain that business in the future? And so we came up with this one pager, compliance approved, and we're able to list out all of our services of what we're doing. And I think now that has really helped whenever I'm going into that same situation and I show this and they're like, this is fantastic. We're not going to be able to have all of these, teams that you have access to in one place to where we can, have basically a very tailored, customized experience, rather than having to go to different people.
Very nice. Looks like a great piece. So if you had to start doing this all over again, Josh, what would you do? What would you advise a 25-year-old advisor starting out?
I would say this industry is simple. It is not easy. It's like losing weight. It's simple. You just take in less calories, but it's not easy. And so in starting out, whenever I was going through like the advisor class, I think there were 35 of us. And everybody had passed the Series 7. We're going to be successful in advising business. And there's about 3 of us left. It's not easy. And because you have to be a coach to people and helping them with their goals, et cetera. You have to be an asset manager, and it becomes very difficult. So if I were to do it again and I was starting over, for one, it's hard because you don't have the experience. You'd like to, I would say, pair up with an advisor who does have experience, so that whenever you go to those clients and you're trying to sell that, story to them of here's why you should invest with me, it would be very difficult to trust somebody with a lack of experience. And so there's lots of, advisors that have a pretty long tenure that would probably be, looking to have somebody take care of their business. And I think that would be a great way to transition. It would be much better to have a really long runway rather than a very short runway for advisors who are looking to exit the business, and then come up with a good transition plan for a buyout over time. That is what I would do if I were going into the industry.
Excellent. Well, it's good advice, and sounds like you have a lot of great stuff going, a passion to do this business, and you build a heck of a show there, Josh. So thank you so much for being with us. Maybe we'll check in with you again later on, and that's all we have time for today. But really appreciate you joining us and sharing your thoughts with us on the Financial Advisors Workshop.
Sounds great. Thanks, Brian.
All right, everybody. We'll leave it there. We'll be back again with another interview with another great advisor just like Josh. And everyone have a great day, and we'll be back soon.